Well, I think most things that are too good to be true tend to be too good. And I think over the last 12 weeks, certainly in Asia, we've had markets go up 11 of those 12 weeks. And every investor has a different time horizon. Some are looking at 3 months, some are looking at 12 months, many are looking at 10 years. And to see markets go up in succession for 10, 11 weeks, I think is just too good. And for that reason, I think investors are pulling back. One other thing in the US in particular that I spotted is that the SPAC market, so special purpose acquisition companies, these companies have raised more than $18 billion in new equity so far this year. This is investors putting money into companies where there's not even a business plan. So that shows you the scale of the excitement that's been happening, which is just unsustainable.
Where do you park your money then to shield yourself from perhaps the inevitable correction that comes with some of the factors that you were just outlining there? There's no doubt that equities are expensive. So essentially, where do you hide?
Okay, well, I think if you're looking for equities which are lower risk, there's quite a lot out there. You go for what I think a lot of investors consider to be quite boring companies, so companies with fairly predictable revenue streams, almost annuity revenue streams. And that means companies like Procter & Gamble, companies like Unilever. Here in Asia, you've got companies like Cal Group in Japan, companies which give you a dividend growth every year, and companies which have strong balance sheets. And these stocks will go up and down like the market, but you've got very predictable cash flows coming from those companies, some in fact paying quarterly dividends. So if you are a bond-type investor or, let's say, a pension fund with liabilities to service, then those companies are something which you could just leave in your portfolio and ensure that you get the cash flows from those to service your liabilities.
Jim, it's Hadley in Abu Dhabi, and we've been talking about this so much in terms of what happens next with regards to the Biden administration's first 100 days. I mean, one of the things, obviously, that we're going to be watching those numbers coming out of the U.S. In terms of GDP later today, but we're also talking about whether or not the Biden team is going to be able to push forward with so many of the measures with Congress. I mean, where is your take on that? How does that impact your strategic thinking?
Well, I think the economic data we've had out of the U.S. Is kind of high-frequency data, but the job data was okay. And also we had some PMI data from the U.S., which was okay. So I think what we're looking to see from the U.S. is probably the scale of the fiscal stimulus and where it's going to go. Now, I think there was quite a lot of talk that Biden would put together spending plans which were ESG friendly, a lot of kind of new energy and eco-friendly policies. But I think if we can get some indication of how much funding will go into support, infrastructure build, the basic typical stuff of building roads, rail, infrastructure, that would give us more of an indication of what it means for some of the old economy stocks. So we don't have any particular concerns there. I think for the Asia region, which is our major focus right now, I would have thought that what we're looking to see is a return to some of the normal diplomacy efforts in terms of the U.S. engagement with international institutions. And that, to us, is going to be more indicative of, let's say, a return to the status quo and more of a normal policy going into 21 and 22.